You know that feeling when the economy seems shaky and the markets are just all over the place? Our very first instinct, our gut reaction, is to protect ourselves. But what if that very instinct is the single most damaging thing we can do for our long-term finances? So let's dig in and break down why that might be the case.
So let's get right to it. We're going to tackle this question head-on by looking at some really surprising data and a common psychological trap we all fall into. We're going to uncover the one mistake that can cost investors a fortune when uncertainty is running high.
Okay, so first things first. If you're feeling anxious about the market these days, you are not alone. And you're not crazy. There's a real, data-driven reason that feels like we're all walking on a tightrope.
So where is all this anxiety coming from? Is it just a feeling? Well, no. Take a look at this number. According to the Office of Financial Research, one key metric places the stock market's valuation in the 98th percentile of its entire history. Think about that. It means stocks have only been this pricey for about 2% of their entire history. Yeah, that's a stat that'll make anyone's eyebrows go up.
And when you see a number like that, it triggers a very primal response in all of us: fear. Fear of a crash, fear of a correction, fear of losing everything you've worked so hard for. And when we feel that fear, our gut just screams at us to do something, right? Anything to make that scary feeling go away. And that brings us to the biggest mistake of all.
So let's give this gut reaction a name, shall we? We'll call it the panic selling instinct. You know that little voice in your head, the one that's screaming, get out now before it gets any worse.
I mean, at its core, it's just a defense mechanism, right? We're literally hardwired to run away from pain. And believe me, watching your portfolio shrink is definitely painful. The instinct is to just stop the bleeding, to cut your losses. But the real question is that instinct actually helping you, or is it hurting you?
To really get our heads around this, let's use a simple analogy. Just imagine your entire long-term investing plan is like a big cross-country road trip.
Okay, so you've got your map out, you know exactly where you're going, your destination. Maybe that's retirement, maybe it's buying a house, some big goal way down the road. But then, bam, out of nowhere, you drive straight into a massive unexpected thunderstorm. The wind is howling, the rain is coming down in sheets, you can barely see the road ahead. This is market volatility. And your immediate natural reaction is just to protect yourself.
Okay, so here's the million-dollar question. In that split second of pure panic, what do? Do you just yank the wheel and swerve off the highway, hoping to find some shelter in a ditch? Or do you grip the wheel tighter, maybe slow down a bit, and just keep driving carefully toward your destination? That swerve, that's panic selling. You might have avoided the storm for a minute, but now you're stuck in a ditch and you're no longer on the path to your goal.
All right, so the road trip analogy is great, but what about the real world? What does the actual data say? Well, let's take a look at what really happened during the last major thunderstorm we all went through. The Federal Reserve has some fascinating data that might just flip your whole perspective on its head.
I mean, think about the period from 2019 to 2022. It was just wild, right? We had a global pandemic, huge economic shutdowns, massive government stimulus, and then a crazy surge in inflation. If there was ever a time you'd feel like yanking that wheel off the road, that was it.
So, with all that chaos, you'd think family finances took a massive hit, right? Well, here's where it gets really interesting. According to the Fed's survey of consumer finances, the median American family's net worth, it didn't just hold on, it actually grew. And not just by a little bit. After adjusting for inflation, it jumped from about $141,000 to nearly $193,000.
Let's just boil that down to one number. A 37% real increase. That means after you account for inflation. This happened smack in the middle of one of the most volatile economic periods we've ever seen. I mean, how crazy is that?
And look, if you think I'm exaggerating, just listen to what the Federal Reserve itself had to say about it. This wasn't just a good period. They said it was the largest 3-year increase they have ever recorded in the survey. It blew the old record right out of the water.
Okay, so the big question is, how on earth did that happen? Well, the Fed's data points to a couple of key things. A huge surge in home values was a massive piece of the puzzle, but so was increased stock ownership. Basically, those who didn't swerve off the road, the ones who stayed the course, they benefited from the incredible growth in these core assets.
And this brings us to our last, and honestly, most important point. The data shows what happened, but now we need to understand why. And it all comes down to something we can call the resilience principle.
You see, the story underneath all that net worth growth is really about quiet strengthening. The Fed's report showed that heading into that chaotic period, the financial health of a lot of families had actually gotten better. They were more resilient, better able to ride out the storm without having to make a desperate move.
And hey, don't just take my word for it. The proof is right here in the numbers. This table is so telling. The median leverage ratio, that's basically your debt compared to your assets, it fell to a 20-year low. But this one is the real kicker. The median payment to income ratio, it hit the lowest level they have ever recorded. Ever. In plain English, that means families just had more breathing room in their budget.
So when you put it all together, it really comes down to two totally different ways of thinking. On one hand, you've got the emotional reaction. It's all about the here and now, the scary weather outside, and avoiding that short-term pain. That leads to panic selling. On the other hand, you have the resilience principle. That's about being financially prepared to drive through the storm because you never ever take your eyes off your long-term destination. Okay, so let's tie this all together. What are the big takeaways here? First, feeling anxious about the market is totally normal, and it's based on real data. But second, acting on that emotion can be the single biggest mistake you make. Recent history shows us that staying the course, enduring the turbulence, can actually lead to incredibly positive outcomes, especially if your finances are resilient and you continue to own those long-term assets. And of course, it's super important for me to say this loud and clear. This is not financial advice. Everyone's situation is completely different. This has just been an educational look at historical data from some really credible sources, helping us understand how people behave when times get tough.
So I'll leave you with this one final thought, a question to ask yourself. Go back to our road trip analogy. Take a hard look at your own financial plan. Is it built to react to every thunderstorm and every patch of fog you hit along the way? Or is it built with the strength and resilience to reach your final destination, no matter what kind of weather you have to drive through on the journey?